I'm not saying that gold's going to go to 3,600. I am saying it wouldn't shock me if it did. The downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends. Leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. The trigger was the dollar shortage, so it was sell gold, get dollars to buy oil because you need the oil. Central bank buying, flat mining output, inflation concerns, uncertainty, etc. Gold should go up. Late this year, early next year, $10,000 an ounce is still intact. Well, why are they buying this gold? No, yes, gold did surpass treasuries as the percentage of total reserve assets. The Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold. Physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. Euroclear and Citadel, DTC. The Russians had $200 billion out of their $300 billion in custody at Euroclear in Belgium.
I want to kick the conversation off with gold and silver markets as we see gold around 4,000, silver around 60, a fairly dramatic correction so far after both metals hit all-time highs in January, although they seem to be bouncing back somewhat today as we speak. I believe silver up close to 4%. Well, what are your thoughts on this recent price action? And is this a buy the dip opportunity or a time to exercise caution in your view?
I'll give you a longer explanation, Jesse, but the short answer is it is a really good entry point, buy the dip opportunity if you want to put it that way. Of course, I watch it closely, and you're right. End of January hit an all-time high. It was 53, 55. That was a closing price. You can get different numbers intraday depending on what ticker you look at, but call it 5,400 for a round number. But I think the ticker I use said 53, 55. It's down around 4,000 an ounce. It dipped a little bit below that. It was a three handle there for a while. It was like 3,900, 3,950, something like that. But you're right. It seems to have settled in around 4,000. So we all see the price action. The question is, what is this? Did we hit a peak and was that a bubble or a hyper spike? And now it's going to keep going down and, get out while the getting's good, etc.
Markets corrected sharply, yet institutional demand never flashed the panic signal retail investors were told to expect. Jim Rickards notes that a retreat from record highs can reflect normal commodity behavior rather than a failed bull market. The bigger question is whether investors are reacting to headlines while central banks quietly accumulate into weakness. Those who mistake volatility for collapse often surrender their strongest long-term positions. Next, Jim Rickards reveals why this correction may actually strengthen the case for much higher gold prices.
Or is this just how it goes? Is this a normal, not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I am sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact. Now, that's easy to say, but let me kind of look behind the curtain a little bit and kind of analyze that. The fundamentals have not changed. When I say fundamentals, uncertainty in the Persian Gulf, uncertainty in the war in Ukraine, central banks are still net buyers. China's buying hand over fist. Mining output is flat. I'm not saying peak gold in terms of mining, but when you have flattish supply and rising demand, that's a recipe for higher prices. And pardon me. We can all see what's going on with inflation. So none of those fundamentals have changed. So what did happen? Well, a couple of things. Number one, when the war in Iran broke out at the end of February, but you can kind of see it coming, they shut the Straits of Hormuz, and there was a time it was a double blockade. Iran was blockading the Straits, and the U.S. Navy was sitting out in the Arabian Sea. So Iran didn't let anybody through unless you were a friend of Iran or China and you paid a toll.
The headlines changed overnight, but the forces driving precious metals barely changed at all. According to Jim Rickards, rising geopolitical tension, steady central bank buying, constrained mine supply, and persistent inflation continue supporting gold despite temporary weakness. Markets often price fear before fundamentals fully unfold, creating confusion that benefits patient capital instead of emotional traders. Ignoring those structural trends could prove far costlier than enduring short-term volatility. Next, Jim Rickards exposes the overlooked chain reaction, linking geopolitical conflict to the gold market's next major move.
But if you met those criteria and you got through, the U.S. Navy was waiting outside to board your vessel, blow you up, and turn you around. So how many people in the world were friends of both? The answer is nobody. You were either pro-Iranian, then the Navy stopped you, or you were anti-Iranian, and the Iranians stopped you. So it really was shut off. And I don't have to recite all the statistics. We all, 20% of the world's oil, 20% of the world's liquid natural gas, the larger percentage of sulfur. People are like, what the heck is sulfur? I mean, they know what it is, but like, why is that so important? It's a precursor chemical in just about every important chemical process you can think of. And then also a major source of helium. Like, yeah, you blow up party balloons. No, yes, but you need helium to make semiconductors. So, and then aluminum, and then nitrogen, nitrates to make fertilizer to feed the world. The implications of this are mind-boggling. Again, people have been through that for the last couple of months. Some vessels are getting through right now. But not that many. Even on a good day, it's less than half the prior traffic. So the idea that, the coast is clear is just not true. Now, what does that have to do with the price of gold? The world needs oil. Now, there is oil around. The U.S. is not going to run out of oil. We have seen higher prices. We're not immune from a world price.
Supply chains rarely fail all at once. They fracture at the choke points investors ignore until prices explode. What Jim Rickards is highlighting is that energy routes also control critical industrial materials, essential for chips, fertilizer, and manufacturing. Markets tend to underestimate logistical disruptions until inflation resurfaces across multiple sectors simultaneously. Investors focused only on oil could miss the broader commodity ripple already forming. Next, Jim Rickards reveals why commodity shortages ultimately create unexpected demand for monetary assets like gold.
But we're a net exporter. We got plenty of oil. We've taken over the Venezuelan oil. We're good friends with Guyana, right next door to Venezuela. They might have larger reserves than Venezuela for all we know. So we're still exploring that. We kicked the Chinese out of the Panama Canal, and Trump's opening up leasing opportunities for oil and natural gas on federal lands, the Gulf of America, Alaska, and elsewhere. So the U.S. is not going to run out of oil. Neither is Russia. But they don't have enough to supply what's missing from the Persian Gulf. So will we send some to Japan because they're friends of ours? Yeah. But what does that do for Malaysia and India and, in Africa and Europe, for that matter, and other places? The answer is not much. Russia could supply all the natural gas Europe needs, but the Europeans just seem to be intent on economic suicide, basically cutting off the Russians for no good reason. So again, how does that affect gold? Well, the answer is all of those commodities I just described are priced in dollars. They just are. And if you want those commodities and they're in short supply and the price is going up, you need dollars, and the price goes up more, you need more dollars. Well, how do you get dollars? Well, one way to do it is to sell gold and get dollars. So that created the downward pressure. In other words, countries, I said central banks are net buyers, and they are, but some countries, including Turkey, Russia to some extent, China and others, sold gold to get dollars to buy oil.
Gold can fall even when its long-term investment case grows stronger beneath the surface. Jim Rickards' argument suggests that temporary selling may reflect urgent liquidity needs rather than weakening confidence in precious metals. When nations scramble for dollar funding to secure essential commodities, even strategic assets become short-term sources of cash. Investors who confuse forced selling with failing fundamentals often exit precisely when value improves. Next, Jim Rickards exposes why dollar shortages can temporarily disguise an accelerating bull market.
So the downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends, all the things we were just talking about. It had everything to do with the fact that the world was short of dollars and needed them, and one way to get them quickly because it's liquid is to sell gold. So that starts the downward price pressure. Then it feeds on itself. So all of a sudden, leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. They're like, hey, it's going down, sell more. And then you hit more stop losses. It feeds on itself, and it keeps going down. So the trigger was the dollar shortage. So it was sell gold, get dollars to buy oil because you need the oil. And then the momentum continued for the reasons I mentioned, which is stop losses and just, momentum traders. Okay, so we are where we are. But all that's beginning to run its course. The war in Iran may continue, it probably will, but some oil is getting out. Other suppliers have increased their output. Oil prices have dropped from, as much as $110 a barrel down to around 70, 67 when I looked this morning at some of the tickers. So that urgency about getting the dollars is diminished. Number one, some oil is getting out, not enough, but it's getting out. So a lot of that pressure is off. And I go back to something that Jim Rickards told me, it was 8 or 9 years ago.
Sharp declines often accelerate because market mechanics overwhelm economic reality for a while. This is where Jim Rickards' thesis shifts from fundamentals toward forced liquidation and momentum-driven selling. Algorithmic strategies and leverage positions can amplify weakness long after the original catalyst begins fading, creating misleading price signals. Patient investors recognize when technical selling diverges from the underlying macro picture. Next, Jim Rickards reveals the historical trading lesson that completely reframes painful commodity corrections.
Jim Rickards is probably the most famous commodity trader of all time. Partner was with George Soros in the launch of the Quantum Fund, and Jim has had a great career, kind of really a legendary figure. He told me, because this was in, gold peaked, the last peak was 2011. August 2011, gold peaked around $1,900 an ounce. Then it went all the way down to 1050, December 2015, 1050. So it was somewhere in that, kind of closer to around 2014 or so when we talked. The gold was going down pretty significantly. And we were in the Dominican Republic having a drink. And I said, Jim, what do you think? And he said, well, I'm holding gold. I'm not selling any. And what he said to me, I'll never forget. He said, in commodities trading, nothing goes to the moon without a 50% drawdown along the way. And if you're not ready for that, you're in the wrong market. Just get used to it. That's how commodities trade. Well, sure enough, now when you say 50% drawdown, you have to pick a base. So if you do the math, I took a base of $250 an ounce. That was the low in 1999. That was like the post 1980 low. Was 1999, $250 an ounce. So I took that as my base, went up to $1,900. So as the peak, divided by 2, took that, subtracted from 1900. Guess what I came out with? 1070. Guess where it bottomed? 1050.
The biggest commodity winners have historically punished impatient investors before rewarding disciplined ones. Jim Rickards notes that deep drawdowns are often a structural feature of powerful bull markets rather than evidence those trends have ended. Wall Street frequently treats volatility as failure because frightened selling creates profitable buying opportunities for institutions. Investors focused only on price may overlook the cycle itself. Next, Jim Rickards reveals why mathematics, not emotion, may explain today's gold correction.
In other words, Rogers was like right on the money. Not surprising because he gets this. Now, not to get too geeky, but there's something as a branch of mathematics called fractal mathematics, and it has a principle called scale invariance. What does that mean? It means if you take a 1-week chart of the stock market and put it next to a 10-year chart, but take out the dates, they look the same. In other words, these patterns repeat at different scales, but it's the same pattern. So taking what Jim Rickards taught me, applying scale invariance, and looking at today's market, now we need a new base because I was using, I think, around $1,800 an ounce up to the 53.55. Take the 50% of the difference, subtract it from 53.55. You come out around 3,600. So in other words, I'm not saying the gold is going to go to 3,600. I am saying it wouldn't shock me if it did. But the importance of that is it's the same pattern that Rogers described to me. It's the same pattern we saw from 2011 to 2015, a little more compressed, but that's okay because, as I say, scale and variance means it's the same thing in a shorter time frame. So on a fundamental basis, which we talked about, central bank buying, flat mining output, inflation concerns, uncertainty, et cetera, gold should go up. But even on a more technical basis, and I'm not a technical analyst, but I do understand fractal math, but using the Jim Rogers rule, a 50% drawdown from 53.55 should not be surprising.
Price patterns repeat more often than investor emotions are willing to admit. According to Jim Rickards, historical commodity cycles may scale differently while preserving remarkably similar structures beneath the surface. That possibility challenges the popular belief that every correction signals a permanently broken trend. Investors ignoring recurring market behavior risk making decisions based on fear instead of probability. Next, Jim Rickards unravels why today's setup could resemble the launchpad for the next major advance.
Well, we're there. So I think this is played out in unsurprising ways. But the other side of that is we're ready for the next stage of the liftoff. So yeah, I think it's a very good entry point.
The sponsor of today's episode is ARK Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arksgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Excellent breakdown. And one of the main catalysts a lot of people have been looking at recently is the fact that gold officially surpassed U.S. Treasuries as the most widely held reserve asset. This was originally reported at the end of 2025. The ECB recently released a report that brought it back into the spotlight. What is this telling us about gold's role in the monetary system? And do you think these central banks stacking gold know something is coming ahead, a monetary reset of some kind? Are they simply removing wealth from counterparty risk? A lot of people point to the U.S. and its allies freezing Russia's FX reserves as a big catalyst for governments around the world to kind of wake up and realize, hey, we need an asset that has no liability or counterparty risk. What are your thoughts on this development?
The reserve system is changing faster than most investors realize, even while headlines stay focused on short-term price moves. What Jim Rickards is highlighting is that central banks increasingly value assets free from political control and counterparty risk. That shift says more about declining confidence in the current monetary framework than any official speech ever will. Savers ignoring this trend may be underestimating systemic risk. Next, Jim Rickards reveals why gold overtaking treasury assets sends a powerful institutional message.
Well, Jesse, you're right about the fact that gold surpassed U.S. Treasuries U.S. dollar denominated assets as a percentage of global reserves. That's just a fact. But it's important to know why. It wasn't the case. Again, central banks are net buyers. I want to be clear about that. That's been true since 2010. But it was not the case that they just dumped treasuries and bought gold, and that's why gold went up. What happened was they had a certain amount of gold, they had a certain amount of treasuries. Treasuries, they can be volatile, but they don't move around that much in price. But gold was more than doubling. It was almost tripling in a fairly short period of time. So, and they were adding gold, but even with the same quantity of gold, if you triple the price, then in dollar terms, it's going to be a bigger percentage of total assets. So yes, gold did surpass treasuries as the percentage of total reserve assets, but it wasn't so much because they were buying enormous amounts of gold. They were buying some. It was because the price tripled, and that's what happened. It's like any portfolio. When you have a winner like that, it's like, it feels good, but you might have to reallocate your portfolio a little bit. So yes, gold surpassed treasuries, but the reason was because the price tripled, not because they bought so much more gold. Now, having said that, it begs the question, well, why are they buying this gold? And that's kind of what you pointed to. Do they see something coming? I think it's already here.
The headline sounds dramatic, but the underlying reason matters far more than the milestone itself. Jim Rickards' argument suggests gold became a larger reserve asset, primarily because its value surged while central banks steadily accumulated more over time. Rising allocations driven by appreciation still reflect growing confidence in monetary metal over financial promises. Long-term investors should pay closer attention to institutional behavior than media narratives. Next, Jim Rickards exposes what central banks appear to recognize before the broader market does.
And what it is, this goes back to 2022 and the Russian special military operation in Ukraine. And it's here we are, 2026. That war is more than 4 years old. It's not going to be over for maybe another year, but it's been a pretty brutal struggle. Russia is winning. They're going to win, but they're in the process of winning. That's very clear. I know the Ukrainians are sending drones to Moscow, but yeah, okay, a little damage, but not that much actually. But what's going on there is that Russia had $300 billion of U.S. Treasury securities in its reserve position prior to the outbreak of the war. And this is the work of Vera Nabulina, who's the head of the Central Bank of Russia. I always say she's the only central banker in the world who understands her job. She's actually pretty good at it. But if you go back to, I'll just say January 2022, before the war, the Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold, physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. But they also had about $300 billion in treasuries. And then the rest was in, some euros and some other assets. So but what do you do with $300 billion of treasuries? Well, the last printed treasury bond was issued in 1979. People talk about digital, crypto, all this stuff. The treasury market has been digitized and with encrypted message traffic since 1979.
One geopolitical event permanently altered how governments evaluate reserve assets around the world. This is where Jim Rickards' thesis shifts from market pricing to sovereign trust, arguing that reserve management changed after financial assets became geopolitical leverage. Once countries question whether reserves remain accessible, diversification becomes a strategic necessity instead of simple portfolio management. That mindset could influence global capital flows for years. Next, Jim Rickards reveals the hidden weakness inside supposedly risk-free reserve assets.
So it might be the original cryptocurrency. But when you have that, you're talking about a digital ledger. Okay, who controls the ledger? Well, now you need a custodian. The ultimate control is with the United States Treasury and the Federal Reserve and FedWire. The Federal Reserve acts as fiscal agent for the Treasury, so they control it. But in between, you have custodians like Euroclear and Citadel and DTC and others. Well, the Russians had about 200 billion out of their 300 billion in custody at Euroclear in Belgium. Because why? They trusted the Belgians, they trusted the Americans. Big mistake. So what happened was the U.S. and Europe together froze those assets. So they're still there. Actually, I say they're still there. They have matured.
Ownership means very little if someone else ultimately controls access to your assets. Jim Rickards notes that digital financial infrastructure always depends on custodians, creating risks many governments previously underestimated. Gold held directly eliminates that layer of dependency, explaining why official reserve strategies have gradually evolved, despite reassuring public statements. Investors should ask who truly controls every asset they own.